Good morning, everyone. This is Barry Knapp with Ironsides Macroeconomics. Merry New Year. A little play on trading places if you didn't get that from the title of the note we released on Saturday morning. It's 8:37 Mountain Time. We are looking at an equity market that is all in on this run it hot outlook, stronger growth. We've got cyclicals up, defensives down, even techs lagging a little bit, despite this being CES week and everyone anxiously awaiting speech from Jensen Huang and Lisa Su from Advanced Micro Devices after that, and all sorts of optimism, we presume, from our friend Dan Ives and all the tech gurus out there. But nonetheless, the market is expecting much stronger growth, despite having gotten an ISM manufacturing survey this morning that suggests that there's no pickup in orders yet. Production's running into positive territory, but orders are not, and backlogs are not, and inventories don't suggest they're low, but they don't suggest they're seeing any pickup in demand right now. So that remains the question. We wrote a report a year ago where we said that when these January themes fail because data comes in that calls them into question, they can be quite vicious in terms of their reversals. So we would caution anyone from chasing the idea that the economy is going to really strengthen early this year, because Friday's report, employment report, may not be supportive of that. We are going to get back to our regular schedule this week. After Wednesday's ADP and JOLT survey, we'll get out a payroll preview note. And then obviously we'll have lots to say on the payroll report itself on Friday. Little preview for you. We do not think the unemployment rate is going to tick back down from 4.6 to 5.45 as consensus expects. We've been noting that the Conference Board labor differential has been accurately depicting what's going on in the labor market in the unemployment rate, and that it was the BLS that had things wrong for most of the year. They converged in November, and that Conference Board labor differential would suggest the unemployment rate's going up this month to 4.7, not down to 4.5. And so that could be a bit of a shocker for people. We're not sure that the market's quite ready for bad to be bad, meaning people questioning the growth outlook yet, but that certainly is a possibility as we get into the beginning of the year. So the note that we wrote this week talked a little bit about the data we're going to get. Obviously, we'll have more to say on the labor market when we put a note out on Wednesday. We're going to get productivity numbers on Thursday, and we would put a big asterisk next to those. We're still convinced that third quarter GDP report we got on a delayed basis several weeks ago way overstated underlying domestic demand. The GDI number was much weaker. That was more like 2.4%. Even that looks a little bit lofty to us. We think that private domestic final purchases were not over 2%. They were reported at 3%. But some of the consumption numbers, for example, and health insurance boosted services consumption, that all looks a little screwy balooey to us, for lack of a better term. But the trade numbers on Thursday could be interesting, right? We're trying to get a picture of just where trade's going to settle in, and we talked about that in the report. You can go have a read of that. That's going to be one of the big issues that hasn't really been discussed all that much in terms of 2026 outlook notes, is what is going to happen to global trade in 2026. Are we actually going to get a persistent shrinking of the U.S. trade deficit? And what will that mean for global capital flows? What will it mean for the dollar? What will it mean for demand for U.S. fixed income? And that's a big open question. So those October trade numbers will be helpful in moving towards getting a better picture around that. We then discussed the regional Fed surveys, and would note that 6-month forward orders are quite strong, but there's no pickup in current demand. And that was evident in the ISM manufacturing survey as well. And our understanding is the S&P manufacturing survey talked about something of a Wile E. Coyote moment where people finally realize that, hey, they're not getting those orders. So we don't have a strong point of view about that, but it's notable nonetheless. That spread is quite wide between expected orders and current orders. But on a more positive note, pricing pressures are easing. Prices received never really went up, but the prices paid survey component is starting to come down for manufacturing. So that would be consistent with what we've been saying about trade and tariff pass through, and our view that most of the hit has been absorbed. We would also note that the services surveys are showing no signs of life, either in terms of capital spending plans or employment plans, which sort of speaks to a not particularly strong employment report this Friday. But again, we'll have a full preview out on Friday. Then we wrapped the note up by talking a little bit about residential housing. We got house price numbers last week. They were a little stronger than expected, but there is a decided downtrend, and notably the major weakness, contracting house prices, are coming in areas of the country that have received population surges over the last 5 years. And so there was a clear overbuilding as a consequence of the Fed's drunken sailor-like Treasury and mortgage-backed securities purchases in 20 and 21 that triggered excessive investment. That's true of multifamily as well. And the rents numbers still look decidedly weak to us. So for anyone who's telling you, yeah, BLS got it wrong with the plugging in a zero for October rents, the BLS numbers are still running above the Zillow blended rent index by at least 1%. All of these came down about 1% over the last year, but BLS is still high relative to apartment list and very high relative to the apartment list new rents. And so, yeah, we could have rental disinflation persist throughout the whole of 2026, for sure the first half of 2026. So makes us relatively sanguine about the inflation outlook. Supply of fixed income is a different story, but the inflation component we think is likely to be very tame. And the market's pricing that, right? We have a very flat break-even curve right now. Front-end break-evens have come down considerably. We wrapped the note up with some discussion about the FOMC minutes and the FOMC outlook. And we made an argument within that the Fed's balance sheet, in our view, is still accommodative. We heard Dave Zervos from Jefferies, we didn't name him in the note, but that's who we were talking about, say that the balance sheet setting is roughly neutral now. We disagree on that. Yes, we're at the lowest level, comfortable level of reserves, roughly. That's why the Fed stopped with QT and is adding some reserves to the system, $40 billion a month. That's only looking at the liability side. On the asset side, the Fed's $6.25 trillion of holdings is still holding term premium roughly 50 basis points below where it would be otherwise. The 3-month 10-year curve that has such a profound impact on return on equity on small banks at 58 basis points or so right now is miles from the 140 basis points long-term median. And it's not a divisor problem either. Long-term rates are about where relatively close to their longer term median. So this is just a very flattish curve as a consequence of the Fed holding so many bonds. Rate policy, on the other hand, is restrictive. So we still have this very unbalanced policy that we think is going to be partially resolved by another 50 basis points of rate cuts in the first half of the year, not the second half of the year. I know the Fed would like to do that. And the minutes implied that is sort of their plan. But if the unemployment rate goes up as we expect, and there's people at the Fed warning about this, apparently Kashgari talked about it this morning on CNBC, the Fed will find themselves overtaken by circumstances and cutting rates sooner than they expected at the time of that December meeting. So that's it for me this week. No comments about Venezuela. Like the rest of you, we thought crude would probably be a little lower. People we talked to over the course of the weekend thought supply could come back online. I know people are saying, oh, it's going to take longer than that. We'll just reserve comments on it. It's not that big a macro factor as of right now. But most notably, we've got a rally in the belly of the Treasury curve this morning. on weakish data from ISM, and we've got a rally in stocks as if growth is going to turn around and rip. And that all sounds kind of incongruous to us. And we're not sure that the employment data this week is going to be supportive of that. We think it's going to be supportive of the Fed cutting rates some more. And there could be very well start to be some questioning of the whole, hey, growth is really going to accelerate in 2026. And growth was strong in the back half of 2025. We just think that piece is not correct. Growth was not strong in the back half of 2025. So that's it for me this week. This video is going out to everyone, free and paid subscribers, but we're going to go back to our more abbreviated format for free subscribers on a as of next week. And as a free subscriber, you're going to miss the bulk of Friday's note. You're going to miss the bulk of Wednesday's note. So consider becoming a paid subscriber. Make it your New Year's resolution. Barry Neff from Ironsides. Have a good week, everyone. Thanks.